Good morning, everyone. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my daily comment for Thursday, December 10th. Well, the collapse in commodities, particularly oil, has been dominating all the markets recently. So today, I'd like to just summarize for you an important paper you might not have seen. Spencer Dale, the chief economist of BP, wrote a fascinating article recently entitled New Economics of Oil. Mr. Dale said that when he joined BP after 25 years in central banking, he had four main ideas about oil. It's an exhaustible resource, oil supply and demand are relatively inelastic, oil flows from east to west, the counterpart being that money flows in the opposite direction, and OPEC stabilizes the market by adjusting supply to match demand. However, Dale says that the U.S. shale oil revolution and increasing concerns about climate change have upended the rules governing the oil market. Now, this is very important to know if you're trading oil or any of the oil-related currencies that I've been discussing recently. First, oil is no longer an exhaustible resource. On the contrary, new supplies are increasing faster than existing reserves are being used up. Furthermore, shale oil drilling gets more and more efficient and may continue to drive down the price of finding oil. That means there's no longer a reason to expect the relative price of oil to increase over time. Secondly, shale oil makes the supply of oil much more responsive to prices. New wells can be started quickly, and wells are exhausted quickly too. So the supply of oil should respond much more rapidly to changes in demand, meaning the prices should be less volatile. Now, I admit we haven't seen that at all yet. In any event, shale oil, not OPEC, will act as the shock absorber for the global oil market. Third, demand for oil in the West is falling as cars become more efficient and North American oil supply has increased. At the same time, demand is rising in China and India as they become richer. So the flow of energy, and therefore the flow of money, is likely to reverse. A key element in the global trade imbalances has completely changed. This is bound to affect currencies, in particular the dollar. Finally, OPEC could stabilize the market in the short term, although, as we saw at the recent meeting, it doesn't have the will to do so. However, OPEC never had the ability to stabilize the market in response to long-term structural changes. As Dale said, the economically sensible response to such persistent shocks is for OPEC to maintain its market share and let other high-cost producers bear the brunt of the demand contraction. And that's exactly what they're doing. The currency market implications are, 1, oil prices aren't likely to go back to their previous highs. This implies that the economies of countries that depend on oil face a long period of restructuring. The Russian ruble, Canadian dollar, and Norwegian krone are the most vulnerable. 2, inflation isn't likely to get a boost from significantly higher oil prices anytime soon. That means central banks that are struggling to boost inflation, such as the ECB, may have to keep rates lower for longer. This is negative for the euro. Third, the U.S. trade picture may change dramatically over time. This is very positive for the dollar over the longer term. In conclusion, to trade oil and oil-related currencies, we have to understand the new rules of the oil market. If you want to read the whole paper yourself, there's a link to it in today's comment on our website. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.